Welcome back to another episode of Unblocking the Chain. Today, we're thrilled to have a very special guest joining us, Jamie Coutts, a brilliant market analyst at Real Vision. Jamie has made a name for himself with his deep dives into financial trends and his keen insights into macroeconomic factors that influence markets. With a rich background in both traditional and emerging markets, Jamie brings a unique perspective that bridges various aspects of investment strategies and economic theories. Today, we'll explore the evolving landscape of digital assets, discuss some pivotal moments in the financial sector, and get Jamie's expert take on what the future might hold. Jamie, thanks for joining the podcast. It's been a while in the making.
Yeah, thanks for having me, Ash.
Can you tell us a little bit about your role at Real Vision with Raoul Pal?
So I'm looking after the crypto research product there. And before that, I was working at Bloomberg Intelligence, but I'd been speaking to Raoul while I was there about a lot of the work that he had actually pioneered around how to actually value digital assets. And so he was actually looking at a lot of the stuff that I was doing and thought that was a really good fit within the Real Vision model because, of course, most people are aware, for those in finance that Raoul's had a very strong macro research product for many years. But he wanted to take Real Vision in a direction towards digital assets or at least enhance that area of the research product. So I came on board and we're creating... there's always videos on digital assets in the crypto industry within the platform, but now there's actual digital assets research that I'm producing, which is, I would say, I've been institutional grade quality, but, for the masses. And as part of that, there's also, new data streams and data dashboards that are being provided to the platform as well. So it's about sort of opening up the digital asset space and, in some ways, demystifying it for retail investors as well as sort of family offices and institutions.
Yeah, my interaction with you and Raoul and the platform is it's solving that problem of not segregating Web3 community. It's bringing Web3 to Web2 or TradFi as we call it.
Yeah,
it's a real and so they can interpret it with their own models and historical type valuation metrics rather than reinventing the wheel.
Yeah. There's a lot to be said about traditional models and how it can be applied into digital assets, and I think that's becoming noticed or is certainly improving. So that's part of building the bridge from traditional finance into the digital world. It's sort of breaking down these ephemeral sort of concepts and ideas about what blockchain actually is, and providing sort of frameworks that make sense to traditional investors. But also that experience in the Real Vision platform. So Raoul's got a lot of rather big ideas about building more Web3 integration into the platform, digital wallets, NFTs. So there's a lot going on. I think that's sort of the model for financial media and content going forward. PDF reports are great, but actually, can you enhance that experience? And Web3's, the technology's there to do that.
Yeah, I totally agree. So why don't we take a step back? Why did you get into digital assets?
So I was a product of the 2008 GFC, as you were. We were both in the markets before then, but it was certainly the watershed moment for me. I didn't come out of that period with answers about how we got there or how to solve it. But I was certainly unsettled by what was happening in the financial markets. And, as we started to see central banks become a much larger player in global finance or in the economy in general, as a lot of that private debt was sort of, nationalized or moved up to the sovereign level, and the policies that were enacted after that, I started to feel increasingly more unsettled about what was happening. So Bitcoin came along and like most people, I didn't get it. I ignored it. But as I sort of had the journey of trying to understand it, I thought there was something there. There was a kernel of sort of potentiality with it. I started to understand what, open software, open blockchains or open ledger, transparent ledger systems could provide to the world, and I became increasingly sort of immersed in it. I was trading it for a little while, and then that sort of just transformed me into where I was working at the time, which is in Bloomberg, doing something completely different, not digital assets. I was working as a senior equity markets specialist in Asia, and I just became the very, very annoying guy inside the firm that was banging the table about digital assets and crypto. And that kind of led me into roles internally with Bloomberg, leading strategy, and then into a research role with Bloomberg Intelligence to create a actual research product. But it was this sort of like 5 or 6 year process. I knew that I wanted to get into it, and at first I wanted to be the advocate inside the firm, and I think I did that. And then opportunities outside the firm arose, and that's where I am now.
Yeah, it's amazing. I mean, I think my journey is fairly similar, obviously not on the research side, but when I think about it, and I think about TradFi or people coming to the digital asset space, I think of it in two ways. First of all, the technology, and then number two is the macro central bank, sovereign, monetary supply sort of scenario.
Yeah.
Do you think most of the TradFi community comes from the macroeconomic side and then delves into the technology and how impressive that is?
Well, I can only speak for myself. I think that would be the case. The reason why I ignored Bitcoin initially was because of the technology. I couldn't, I didn't have a technology background, so I found the whole cryptography element actually difficult to understand, and that was sort of a blocker for me for a couple of years. But everyone has that journey of like overcoming that and educating themselves, and for some people it's very fast and they do better because the space is obviously growing and there's a massive secular trend underpinning it. But yeah, I think it's generally because people are strong in finance, but that doesn't always give you the tools to understand it either. I've worked in finance long enough to know that there is, there are entrenched beliefs and myths about the way the economy works or finance in general or investing in general that has kept people away from the digital asset space. But that's changing. Like, we're here today doing a podcast. You've got an amazing asset management firm that's accumulating assets and, is at the frontier of this. And that was, we weren't here 5 years ago in the similar situation. So it's changing.
Yeah, I tend to agree. I mean, I remember when I was introduced to it in, let's say, 2012, 2013, and someone came up to me and said, this is going to take over, the US dollar. And I'm like, I certainly couldn't understand that. And I don't think it takes over the US dollar still to this day, but I couldn't get my head around, how would government ever allow this to happen? When I think of it now, and Raoul and you were, talking about Bitcoin as an example, as a digital gold, then it makes a lot of sense, right?
Yeah.
Rather than taking over monetary policy per se, which is a very difficult thing for any government or central bank to give up. It makes a lot of sense, and it's just more efficient. Transfer it, it's quick. You don't have to store it. There's no logistical issues.
Yeah. So that's the thing. I think it's the framing of it by certain people in the industry at the beginning immediately put a lot of people offside, especially those in traditional finance who have sort of, have come on their journey in a system that has benefited them to some degree. I always struggled when I communicated the idea of open blockchains or Bitcoin, and specifically, in the context of a let's say within Bloomberg, or if it's sitting here in Australia, where we have a functioning financial system, we have instant settlement. There is half the world that doesn't have an effective financial system supporting them, either because the the companies, the banks, the financial players choose not to service them because it's unprofitable. It's uneconomical for them to do that, and that is the choice of companies at the end of the day. And I don't begrudge them for that. Or it could be the fact that they are in a jurisdiction where they have run afoul of their government or special interests, and they simply cannot be banked. So, I always found it, surprising that people don't put themselves in the shoes of others to understand if there's a technology that can radically transform, improve, the social situation of the world and give them access to finance. Why wouldn't that have been endorsed faster? But it's just that people, think through a certain lens and they don't necessarily think outside that lens. So yeah, it's it's Bitcoin and blockchain is for everyone.
Yeah, and I think that's a really interesting point, because I think once you do, some work on it, you realise that technology can help a lot of people. If you think, we want to make the transactions faster, cheaper, as a society, it makes a lot of sense. So the question then is, do you think the terminology or the education around this has got to be improved? I mean, we think about this a lot at the moment and how to express it in traditional finance or real world terminology, not to, spook people. I mean, NFTs, for example, is the colloquial language at the moment, but in reality, it's just a digital deed.
Yeah.
Which I think resonates with a lot more people.
Yeah. And I'll give you an example of how I've sort of changed terminology as well. And I think there's labels that get used initially because, like certain memes, they just become very, very popular, but they don't work really with certain segments, or they lose their meaning over time. So as much as I believe that, blockchain technologies are essentially decentralized, I prefer to use the term, open ledgers or open technology or open software, because, decentralization is a spectrum, as we know. So there are some of these, if we look at just the infrastructure of the crypto economy, which is the blockchains themselves that are providing the block space upon which you can build essentially companies in the crypto universe. We call them, applications or decentralized applications. There is a spectrum between, one protocol over here and another protocol over here in terms of that decentralization aspect. But they're essentially open. They're voluntary. You can opt in. You can choose not to actually even transact in those crypto economies, but you could choose to become a validator and secure that network and receive an income stream from other people choosing to opt into that network. And so I find that terminology slightly better, but everyone has their preferences.
Yeah, I agree. I think the terminology or clarity around what actually, the utility of some of these tokens, if you look at network tokens, right? I mean, there's real functionality around those, but people sort of mix them in with a pixelated head, right? Or a piece of art, and very different, utilities.
And that's why, like, one of the biggest criticisms of crypto is that people will say, well, there used to be like 50 tokens. Now there's 30,000 tokens. Well, okay, so that's just really a task of classification. Like, are 30,000 tokens the same as 30,000 blockchains? Well, no. I mean, within the top 200 assets, there's 80 blockchains or thereabouts. So, the space is so nascent and young that the development of proper classification terminology is now catching up, but it hasn't been there for a while. So, in the same way as we look at the Australian stock market and we have the GIC sectors, right? So we know how to sort of classify and allocate amongst all the different sectors. That is emerging within the crypto space as well. So you'll be able to make decisions as to allocate into, dApps or infrastructure plays or blockchains or digital currencies. And so terminology is a big thing, and it is improving. And with that, improves the ability for investors to make choices of how to allocate into the space.
It's a really interesting point. It's all bucketed into one group at the moment. In reality, there's lots of different categories. So let's move on from that. Why do you think people should invest in the digital asset space?
Well, you've touched on one of the points, which is currency debasement, right? So I think that there's lots of different reasons why, and people come at it from different perspectives, but I believe it just needs to be distilled into two main secular themes. One, currency debasement. We are living in a fiat-based, credit-based monetary order, and it's inevitable that we move into ever-increasing amounts of debt and ever-increasing amounts of currency debasement to support the debt. So that's the hurdle rate for everyone as an investor. And with that in mind, the other major secular trend is technological innovation. So, what has outperformed over, most time periods looking back 20, 30 years? It's been technology stocks. So the ability to, so really it's a matter of being exposed to the assets that will outperform the currency debasement the most. And so if you just look at historical metrics, if you look at Australia, actually, in the last 10 years, we've seen an 80% increase in the money supply in Australia. So that's about an 8% growth. Australian equities have grown at about 10%, so it's outperformed. Property has grown a little bit more than the money supply, but you can lever that up, so it's actually not a bad return. Bitcoin's up 1,200%. Sorry, 12,000%. It's insane. Now that return rate's coming down over time. So the reasons why I believe you need to have an exposure to it is simply because you need to be able to outpace the currency debasement. And there are S-curves or exponential growth curves in technology adoption all over the place. It's not just in blockchain. You can look at genomics and all these other technologies that are being radically adopted. But blockchain is one of them. So it's no longer a question of if, it's really a question of how do you do it and what's your position size.
Yeah. Yeah. And can we just go back to the debasement. What is that effect for a household? What does that mean? I mean, obviously we've got inflation, which is causing issues at the moment. And so that's, call it, a 4 or 5% problem.
Mm-hmm.
Can you just talk about debasement and how that also adds on top of that in regard to purchasing power? And so you've got to think about this debasement and inflation and that total number, not just inflation.
Yeah, so I'm in the camp that the real inflation rate is the monetary base, is the amount of money or stock in the finance or in the economy. Because if you go back to 1971 or when we, I think it was 67 that we changed the currency unit, we have effectively debased at about 10 to 11% every year on year.
In Australia.
And it goes up and down depending on what's happening in the economy, but on average, it's about that. Now, I think inflation's, like Michael Saylor said, is a vector, right? Your inflation's different to my inflation, and my inflation's different to someone else's inflation. So the CPI has a lot of issues with it, but it's also unfair to it's an average to say that one person, that we're all experiencing that same inflation rate. Let's put aside the manipulations that go into the calculation of the basket itself. So when I think about it through that lens, then, I have, typically most people will be indexed to CPI in terms of their wages, but the real inflation rate for people is much higher. So real wages are going down. That's why people are really feeling it now. It was subtle until COVID, until they expanded the monetary supply. I think M3 went up about 25% in the space of 2 years. So it went exponential. And we're all paying the price for the decisions made during that period, which essentially increased the money supply. So for households, it's especially tough because everyone here in Australia is so levered into property that they've had to experience the increase in interest rates, but also just the price of everything else has gone up, but wages have not kept up. So it's net, you're worse off than where we were 3 years ago, unless, of course, you are extremely exposed to the best performing assets, which has been technology and Bitcoin and crypto to some extent as well. But that tends to favor people who are in the upper half of the income bracket.
Yeah, so that's interesting. So we just think about that. So your essentially wages or household income has to keep up with inflation plus the annual rate of debasement. So of those rough numbers, let's use 4% for inflation, 7 or 8% for debasement on average over the the time period. So you're looking more 10 to 12%. Your annual income needs to rise, or your assets need to rise.
Total wealth
Needs to rise to offset that and essentially remain flat on purchasing power.
Just to remain flat, yeah. Yeah.
Okay, that's interesting. And if you look at the indexes, I mean, Australia's been relatively lucky, 10%, you said, but
yeah, once you add in dividends, it looks like it's flat. When you add in dividends, you get that sort of 10%, 12% return.
Yeah, right. So it's interesting. I mean, obviously, then you look at other markets, and actually, if you chart it against monetary supply, it's the same return,
more or less.
So the US indexes,
US has done better
because of the tech component, right?
I think a lot to do with the tech component, and just because the world is short dollars. So I mean, it's just it has that exorbitant privilege, I think, but it does have that technology aspect as well, which favors that market from an equity standpoint over other markets because of the strong equity sector that it has.
Yeah, interesting. So, if you were running analysis institutionally at the moment, how would you think about allocating in a portfolio? I mean, obviously, you're not going to go, I understand, potentially understand what we just spoke about. I'll go and do some research on it. But you're going to think about allocation and what bucket it sits into. What sort of percentage would you think about allocating to a portfolio?
Well, I mean, it depends on your expectations for future returns. But let's just say that you just want a conservative approach. I would think that really 1 to 3% is pretty conservative. It depends on your age as well. Like if you're younger, you should have a higher allocation than someone who's obviously older. But, I think there is a case to be made now that Bitcoin is moving into the sovereign nation state level of the investment adoption curve, that the allocation should be a lot higher. I think about the allocation to the space in general as there's Bitcoin and everything else. And I think Bitcoin is the monetary head. It's a really strange hybrid between technology and a monetary investment thesis put together. It's got product market fit. It's known product market fit because there's 200, 300 million people globally that have adopted it. And everything else is crypto. So I kind of look at that as like the emergent technology sector. The GICS tech sector is, with three times the volatility, but also, a superior risk-adjusted return as well, is crypto. So if you take 1% as your allocation, how you allocate between that's another discussion, depending on your sort of risk tolerance. But I think generally for institutions, that number is going to have to be higher than 1 to 3%, and it could actually be in double digits for some institutions as well. I mean, BlackRock, don't quote me on this, but there was a report that BlackRock internally ran their models. They have, the Aladdin risk system. And when they did their modeling, their allocation towards Bitcoin and crypto was high teens.
Yeah.
So it depends on your risk profile, but it's definitely not zero.
Yeah. Tend to agree. Probably wouldn't be here if it was zero.
Yeah.
So this, obviously it's getting a lot of airtime at the moment. It's in the news. It's moved into the political sphere in the US, clearly. A lot of talk about it coming up to the election later this year. How do you think about this? Is this political poetry, or is it really, we're going to change, we're going to hold it as a reserve asset, or is it just trying to get votes?
No, I think it's real. Senator Loomis has got a bill. I haven't looked through the details, but the bill won't, I don't think it will succeed, at least not prior to the election, and unless there's a change of control in the House and the Senate. But no, I think it's not bluster. I mean, Trump's journey with Bitcoin has been pretty prolific. He was steadfast against it only a couple of years ago. He may be blustering a little bit, but the Republicans are not blustering. They are putting bills in front of Congress to try and move this forward, to take those Bitcoin that I think the DOJ has, and actually move it into the Treasury as a strategic asset. And, they're even proposing rules for transactional sort of freedom or transactional privacy, which is, as a people who believed in Bitcoin, like, it's not just digital gold. It's about, sovereignty over your transactions, your movement of capital. So I think, the other point here is really that it's not just Republicans, it's bipartisan. So prior to the whole talk about strategic reserve asset status, like in the last 6 months, was the stablecoin bill and the financial innovation bill. So bipartisan support from Congress for the stablecoin bill. Now, Biden vetoed that against the wishes of the Democrats in the House. So that's fascinating pivot or turn of events, and we can talk about why the stablecoin bill is so important, to your point about how Bitcoin can actually strengthen the dollar. And then the financial innovation bill was just, providing for the first time, because the SEC failed to do so, some actual guidelines about how to regulate the space, and not just Bitcoin, but like the blockchains themselves, and provide some guardrails for investors and for the public, and bring forward some common sense disclosure rules for protocols that are launching, raising capital, so that some of the hairy stuff that's been happening, because there's been no real constructive regulation or regulator in the US, to change that and allow innovation to come back to the United States, because they were all pretty much moving overseas.
Yeah, I think we all think regulation needs to happen. Everyone needs to know where the goalposts are. So I think, there does seem to be a shift from the Democratic side, and certainly some of the senators coming out suggesting that they are in support of the bill, and, as a reserve asset, they hold it personally. And I feel there's a little bit of a softer tone, whether that's coming from the SEC or the Democratic Party, about, this is important politically, which is probably grabbing the headlines, but also strategically, there's something here.
Yeah, and it's like crypto is non-political. Like, they've taken so many polls where, the people that own crypto are from both sides of the aisle. Up until recently, it was only one side of politics that was trying to move the needle, but quickly we have seen the younger congressmen and senators from the Democrat side start to really push hard, and that's how you got sort of bipartisan support for those bills earlier. So it never really, I don't know how it became political, but it seems like everything does these days. But I think it's now getting to the point where it's we're going to see bipartisan support and big changes after the election, irrespective of who gets in. And the other point is that it's bipartisan, but it's also intergenerational, right? Senator Warren and the people that were, that formed the anti-crypto army, so to speak, they clearly are of a certain generation, and there is a passing of the baton kind of a moment that's happening in the US, and we're starting to see far more vocal younger members of the legislature starting to really make their voices heard. So, it was always going to happen, and it's great to see.
Yeah, that segues nicely to the next question. So lot of stuff moving in this, in this sector. Probably back to your, previous life. So we've now got election year. We've got interest rate decisions happening in a lot of places. We've got, inflation slowing down. On the macro side, it's starting to get interesting, and a lot of commentators are out there. The central banks in a lot of places potentially could be cutting rates, adding liquidity. So, the correlation between digital assets and interest rates / monetary supply / liquidity is important. And it seems to be, as Raoul and Real Vision and you guys talk about, coming out of spring and into summer, it seems we're getting closer to that, and certainly our opinion as well. How do you think about that? I think the demographic, generational issue is big as well. If you're young, you want something that goes up faster than, 10 or 12%. So there's a lot of factors. What's your view on the macro interest rates, liquidity?
We've had a really elongated cycle this time around because of what they did during 2020 and 2021 with the amount of monetary easing that took place, just the unprecedented nature of it all, and inflation flared up, and that meant that that the monetary conditions had to be tighter for longer than what they would have liked. But the math doesn't stack up anymore for tight monetary conditions and high interest rates. The US debt, the interest on the US debt has gotten to a point where, it's now no longer fringe elements that are talking about it. It's pretty much, on the agenda of most discussions. And that is the reason why Bitcoin as a strategic asset has flared up. So I might circle back to that, but I'll finish off the bit on the liquidity side. So you've seen peripheral central banks cut, but everyone's waiting for the US. Just recently, we obviously saw the 10 years collapse. So they're pricing in 3 cuts. Whether that happens before an election, I'm not entirely sure, because it may look to be political. But the point is that that liquidity is about to return, and the important thing, I think, is that you don't necessarily need. The reason why digital assets basically bottomed, or Bitcoin bottomed in Q4 of 2022, and then the rest of the space in mid-2023. The rest of the space took longer because the SEC was going after them hard. So there was a lot of, there was still a lot of risk in that space. But Bitcoin, because it had commodity status, bottomed in 2022, really on the back of the fact that the liquidity tightening that we saw in 2022 was sharp and upfront. Like, they took rates from 0 to 4.5-5% very, very quickly. But the rate of change then slowed, right? They basically reacted quickly. And at that point, everyone knew that they couldn't really tighten any further. And so as long as tightening slows, markets can adjust and start to move higher, because they'll start pricing in the next 12 to 18 months, which will inevitably be looser conditions, because where debt is in the US, or where debt is globally, you can't sustain tight monetary policy for too long. Like, the risk of the collateral collapsing is, way too high. They'll do anything to avoid it. So we saw the banks start to collapse in the United States, and there was measures, emergency measures. We saw problems in Japan. We saw the UK pension system at the end of 22, blow up, and there was special. So they've done these very sort of surgical liquidity injections. They haven't sort of, moved into a liquidity expansion phase, but that was enough to signal to the markets that the game is up. Really, it's just a matter of time, and crypto moved higher on the back of that. So yeah, I think we'll see the measures come through towards the end of the year and next year, and that's generally pretty good for all risk assets. But Bitcoin and crypto outperform all other assets, so they should do reasonably well.
Yeah, I tend to agree. I mean, I think, it's interesting, and I think a lot of Western central banks have got them, it's hard, right? It's is inflation stickier for longer? And that's fine, but you're also crushing the real economy. And that, I think some of that data, in official data is now, delayed official data is now coming through. And, you look at some of the statistics, it's not looking all that good. So, what do? Are you trying to address inflation, or you're trying to keep the real economy going? And it seems to me it's a tightrope at the moment.
Very, very tough. I think they'll just have to be. We will be living with high inflation going forward, because they'll have to ease and make sure that there's no calamity, and that just means that inflation will probably run at above the 2% target, and there's probably going to be some adjustments by central banks as to what the goalposts are there. The other aspect too, which relates to digital assets, is like there is a way out of this debt spiral or this problem, which is you grow, and you grow fast. If you can grow faster than debt growth, you can start to eat into the imbalance between debt and GDP. So the policies over the last couple of years to stifle innovation were pretty short-sighted, because it is only through innovation. If blockchain delivers what I hope it will be friction or less friction in payments, a higher velocity economy where money moves through the economy faster, because blockchains can move money faster and cheaper than traditional rails. And if you unlock or you remove that friction, you inspire or create opportunities for entrepreneurs, for businesses to grow. And, the AI element is interesting as well. But if you just do that alone, you sort of take the foot off the throat of businesses, then that could be a lever to pull. And I think they're starting to get it, at least in the US, not everywhere, but they're starting to get that. They have to grow. And so what pockets of the economy are growing? Digital assets are exploding, but they've lost 15% or, what's the number? I could be wrong on this, but the developers within the blockchain space or the blockchain ecosystem, US had about 50 or 60%. It's down to like 29% in the last 3 years. And that's just because they've basically been telling them that they're not welcome.
Yeah, and I think it's the growth, obviously, outgrow it, and that comes from productivity.
Yeah,
which obviously blockchain efficiency, saving costs, time, etc. Obviously AI should dramatically increase, if used correctly, the productivity. So technology does seem a fairly significant driver to get this growth that's needed.
Yeah, and again, the use case for blockchain is that if you just look at the growth in the number of users in blockchains, increasingly it's bots and AI, and that's leveled as criticism about the space. But that is the world that we are moving into, and as we sort of get to the next frontier of AI, which I think will be in the next 12 to 18 months, where we start to see AI agents, whether they're autonomous or whether they're self-directed, doing stuff for humans, where there is a need for a commercial payment or transaction to take place, how is that going to be facilitated? It's only going to be facilitated, the way I can see, is like through digital wallets or Web3 wallets on blockchain rails, because there's no way an AI can provide a driver's license to a bank to get a fiat bank account. I mean, it all sounds farcical, but it's literally around the corner. And so OpenAI at the moment, is just one is the first iteration, but there is I think products out there that'll be in 12 to 18 months where you will direct your AI to do things on your behalf, and there will need to be, whether it's like in my role as research where I'm acquiring data from this place and I need to show provenance, it needs to be all done through technology, whether it's, zero knowledge proofs, which is really sort of like techie term, or digital wallets, where those digital wallets could be controlled by me, but I give my agent certain permissions and it needs to be fast, and maybe it's micropayments which you can't facilitate with a fiat bank account because the fees are too high, or so it's all happening. So that to the innovation play, like the AI element is going to drive innovation, and they need essentially blockchain to facilitate commercial transactions.
Yeah, totally agree with that. So just like sort of at a very high level, we could talk about this for days, but where do you see, probably more in Australia, where do you see the banks, corporates and, investment managers in this space?
Well, I should ask you about investment managers. I think they're more ready to move into this space than maybe the banks are. The banks have been extremely reluctant. But I think that you're in a sweet spot. Jelly season, this sweet spot where there will be managers who are outsourced to digital asset experts to allocate into the space. Some will build in-house teams, but there will be initially, I think, a lot of outsourcing of that skill set. And so that will just be, it's already happening. Like we've got BlackRock, Fidelity, and Franklin Templeton, all with crypto-based products at the moment. So that's managed and ETF-based products. So like that's happening. That's inevitable. The bigger question is about the banks and the corporates. So if we talk about the banks, I mean, it's very unfortunate that we live here in Australia as we are looking across at what's happening in the United States, where there's a massive shift in attitude. And, the banks are essentially, I think, about to lobby pretty hard to get access to the ability for custody of digital assets. Whilst in Australia, we've got banks essentially debanking or censoring transactions for people wanting to invest into the digital asset space by trying to transfer it to a exchange. So we are definitely behind, but I see it as inevitable because the custody element of digital assets has pretty much been solved really since 2020. So it's just the political will and the regulatory environment that needs to change here. But I think it's somewhat inevitable. And as for corporates, whether it's cross-border transfers, which is really problematic and expensive and a real area of high friction in the economy, where blockchains could be a great solution. We desperately need a stablecoin industry in Australia. Like, if we just sort of think about what's happened with like the US and the stablecoin bill, which admittedly didn't get approved because it was vetoed, but it had bipartisan support, so we'll get through. Do we want to be in a situation in Australia where everyone has access to US dollar stablecoins? Right, so everyone has apps, neobanks and crypto exchanges where I can just park my Australian dollars in USDC or USDT and have access to US dollars, but not have access to an Australian dollar stablecoin, which, I need to facilitate Australian or domestic transactions in. I'll just use USDC instead. Like, I think we need to really step up our game here. And then the other element is just corporates. Like, if you've got excess cash, are you going to hold Aussie dollars and earn 5%, in Aussie bonds, or are you, when in monetary inflation is at 10%, so you're earning a negative real yield of 5%, or are you going to park some of your excess reserves in Bitcoin, as more and more companies are choosing to do at the moment? So there's many different facets to it. Like,
yeah, I think it's interesting. There's obviously some, headline stories around Michael Saylor and MicroStrategies and other corporates are now, and their share prices benefit greatly and very quickly from it. So one question I like to ask everyone, if you and I are sitting down in these seats in 5 years' time, where are we in this space?
Bitcoin's a strategic reserve asset on the balance sheets of many countries. And the crypto industry as a whole has, I would expect within 5 years, for the regulatory picture to be very, very clear. And with that, a multiple expansion in terms of the daily active users on blockchains at the moment. So I think the numbers are around, if we talk about, say, monthly active users, which tends to be the way TradFi thinks about, the software companies, it's about 150 million. I think in 5 years' time, it's 10x that. I wrote a paper back in November which just looked at the growth rate of daily active users, which was only 5 million back then. Now it's 15. So it's up 3x in the space of less than 12 months. It'll hit 100 million by a decade. And if you just look at the correlation between the number of users and prices of blockchain assets, I won't give specifics, but it's a lot more.
Yeah. Well, Jamie, thanks for your time. We could sit here for hours. Where can people find you?
So realvision.com for financial content. I put a lot of stuff up on Twitter. So handle is @Jamie1, number 1, Coutts.
Thank you very much. We'll do this soon.
Thanks, Ash.
Cheers,
Appreciate
Jamie.
it.
Bye.